answer any questions. So just getting us live here on Facebook right now. And looks like we are there. Okay, so we are now live on Facebook. So we do have about 1 more minute to give the last minute stragglers a chance to log on to the Zoom session for those of you that are joining us live. And of course, anyone who's joining us on Facebook, thank you for dialing in. I'm going to share my screen here. And hopefully you guys are seeing personal and corporate tax planning, what you should know. If anyone's not seeing that, please do let me know. But your screen should be coming up now about personal and corporate tax planning, my slide deck. And that's today's session. We're going to be talking about personal and corporate tax planning. What is it? With your money that you're able to save at the end of the year, where should you be saving that? Should that be saved inside of a corporation? Should it be saved inside of RRSPs? Where should you be putting that hard-earned money to reap the greatest financial advantages for you? So let me walk you through the agenda. I'm going to start with a little bit about who we are for those of you who are not already clients. Then we'll discuss briefly what is tax planning. Then I'm going to have a brief discussion on salary versus dividends, because this is a question that we get all the time, and it is sort of related to your sort of tax planning and even whether you're going to contribute to RRSPs or TFSAs, because if you're doing dividends, you won't get any RRSP room. We'll talk more about that when we get to that section. Then we're going to look at income splitting, understanding the pros and cons and how you can do that. And lastly, we're going to get into the weeds with, the pros and cons of RRSP versus tax-free savings accounts versus RDSPs and RESPs and corporation savings and unregistered savings, and help you figure out for your personal situation, what's the best scenario for you. Now, as I mentioned, for those of you who are joining us live on Zoom, you can ask us questions as we go along. So please use preferably the Q&A channel. You can also use the chat, but I'll be looking first to the Q&A channel and then to the chat. And then lastly, you can also raise your hand if you do want to speak up and chat with me using your voice. So I'll be keeping an eye out for that. But if I do happen to miss it, I will circle back at the end of the session to come back and make sure I've answered as many of the questions and answers as possible. So again, like to keep this as interactive as possible. And for those of you who are joining us live on Facebook, we do have a colleague who will be monitoring the post there. You can just comment on the post and we will have those relayed over to us live with maybe a minute or two delay. So without further ado, let me tell you a little bit about who we are. So CPA 4IT is a chartered professional accounting firm based here in Toronto, but we service clients all across Canada with the exception of Quebec. We are a member of the National Association of Computer Consulting Businesses, which is a national group representing some of the largest staffing agencies in Canada. And we have helped literally tens of thousands of independent contractors over the years. And we have been specializing in independent contractors since 1984. The firm was originally founded by my father, George Wall, and we've been niched or specialized in service-based professionals and IT contractors since the very beginning of the firm. And that means we've got really specific knowledge to this industry and the issues that you guys face. So this is going to be great content for those of you that are service-based professionals. If you're in manufacturing or retail or e-commerce, may not be the best content for you, but we'll do our best to see how we can provide value to all of you. We are also an ISO 9001 registered firm, which means we have systems, processes. Those are externally monitored, and they strive for constant and never-ending improvement. So again, bear with me as we go through a little bit of marketing info here for those of you who are already clients. The number one reason that people do choose to work with us is we offer a free initial consultation where we'll sit down and look at your personal situation and see if we might be able to assist you. We also offer a turnkey solution. We can help you with the actual incorporation of your business and get started, and helping your business get started. We can help you with the bookkeeping. We can help you with the accounting. And we've got relationships with financial planners, insurance brokers, lawyers to help you with the entire life cycle when it comes to your accounting and finances. We like to think of ourselves as your financial quarterback, where we can bring in those team members who can assist you with the areas where we're not experts. We also provide a benchmarking analysis to show you how you compare to the average in your industry, to show you whether you're above or below the average. And this is really an essential tool because it helps you to pinpoint the areas of risk. If you're above average, there might be a higher risk that CRA might audit or review those numbers. Doesn't mean they're not deductible. It just means we better make sure we've got the documentation in place so that if CRA comes knocking, we've got the answers for them. And it also, on the flip side of that, identifies opportunities where you might be below the average and missed out on eligible deductions that you're not aware of. Lastly, we're going to back up all this work with audit representation protection, which means if you are ever audited for any of the work that we've prepared for you, we'll represent you up until the third and final stages of appeals at no additional cost for you. And anyone who's ever been through an audit knows how stressful and expensive those can be. And we want to do everything we can to increase your net worth and reduce your stress. And that's why we're here. So on that note, today's session is really about increasing your net worth and talking specifically about optimizing your tax planning. So what is tax planning? Tax planning is the analysis of a financial situation or plan from a tax perspective. The purpose of tax planning is to ensure tax efficiency. Reduction of tax liability and maximizing the ability to contribute to retirement plans are crucial for success. Basically, tax planning is how do we make your money work most efficiently for you? So this is looking at strategies around remuneration from the company. How much money are you taking out of the company? Is it coming out in the form of salary? Is it coming out in the form of dividends? The money that you have left over, where are you going to invest that? Is that going to be invested inside the corporation? Is it going to be invested inside of tax-free savings accounts, RRSPs, RDSPs, RESPs? The list goes on, right? There's a lot of ways that you can get your money working for you. And the most important thing I want to say when it comes to tax planning is it's an art, not a science. There is no right or wrong tax planning. It's figuring out the best solution for your specific needs, and doing a plan based on as much information as we can possibly gather, recognizing that there's going to be lots of things we don't know about the future, and we're just planning for it as best as we can. So when it comes to tax planning, one of the largest things that we're looking at is the marginal tax system and the marginal tax rates. For those of you who aren't familiar with the marginal tax system, the way it works here in Canada when it comes to your personal taxes is there's different brackets, and you can see that we've got them listed here. They start at the first $44,740, and they go up as high as $220,000. And as you can see, as your income goes up, so too does your tax rate. Now, one of the most important things to be aware of a marginal tax system, when your income goes above one of these thresholds, it doesn't mean your entire income is taxed at that new threshold. Only the income that's above that threshold is taxed at that new rate. So you're always, if you've got income over $44,740, that first $44,740 is always going to be taxed at that 20% rate. And it's only income above $44,000 that is going to be taxed at these incremental rates. So one thing you'll hear us talk about is marginal tax rates versus effective tax rates. So marginal tax rate is the tax rate on the last dollar of income that you earn. So for example, if you earned $221,000, your marginal tax rate would be 53.53% because you've got $1,000 into that highest tax bracket. But that wouldn't be your effective tax. Your effective tax rate would be your total taxes that you're paying divided by your income. And that's going to give you an effective tax rate. So when we're doing planning, we're usually looking at both the marginal tax rate and the effective tax rate. So we're usually trying to use strategies like RRSPs, deferrals, home loans, auto loans, directors advances, shareholders loans, these types of strategies to keep you within a specific marginal tax bracket. But we're also looking at the effective tax rate, because we might have your income where you've only drawn out $20,000 out of the corporation, and your effective tax rate would be in that situation lower than the corporate tax rate, which is only 12.2% here in Ontario. But because you have a basic personal exemption of about 11,000 and change, which unfortunately we didn't have listed on this spreadsheet, you get a certain amount that's tax-free, and your effective tax rate would actually be less than 20%, and in fact less than 12%. So we might want to look at declaring more income than we're required to. Now, when it comes to tax planning, we're just going to really touch on the surface of what that tax planning is, and understanding that it revolves around these marginal tax rates. And it's important for you to know and understand what these different rates are and where the thresholds are, because they can help you figure out whether you should contribute to RSPs and use your RSPs to bring you down to a different threshold. And we'll talk more about this when we get into the RRSPs, and how RRSPs can be used very effectively to bring you from one tax bracket down to another, and why you should not contribute to your RRSPs if you're earning income under $44,740. So we'll talk more about that as we get to the RRSP specific section. But the number one thing I do want to tell you when it comes to tax planning is this should be done with a professional who knows and understands your entire information, so that you can get the most effective plan possible. But the more information that you have and the more knowledgeable you are, the more effective that you and your accountant can be when you work together to figure out an ideal tax planning situation for yourself. So there are quite a few strategies that you can use to optimize your tax planning. We're going to touch on a few of those today. So dividends, and as I mentioned, we're going to talk about dividends versus salary. Smoothing income, this is the ability to defer income, and it can be done with home loans, auto loans, and something we call a net debit balance, which is sometimes referred to as a single purpose loan. But the goal here is that if you can have your income as smooth as possible and avoid peaks and valleys, you'll end up with a lower tax rate. Because of that marginal tax system, if you had 1 year of $100,000 of income and another year of $10,000 of income versus 2 years of $55,000 of income, you would end up paying less tax with the 2 years of $55,000 than you would with the $100,000. And that's because of those marginal tax rates. When you go into peaks and valleys, you're going to end up paying more tax than when you can smooth it. And that's one of the great strategies that's available to a corporation, is the ability to smooth income by using income tax deferral strategies that are available to a corporation, as well as leveraging things like income splitting. We will be talking more about income splitting and how that works, and the impacts of Tfsa that came in basically Jan 2019 or the end of 2018. And what impacts that's had on income splitting. But income splitting is still a very real strategy that can be used to optimize your tax planning. And of course, leveraging and taking advantage of the small business deduction. So the small business deduction here in Ontario allows corporations to have their first $500,000 of net income in that corporation taxed at only 12.2%. And that is a huge advantage, especially compared to the personal tax rate, which can go as high as 53.53%. So if we can use the corporation and the small business deduction to pay tax at 12.2% and smooth income and defer it, we end up with a much lower total tax obligation by using these strategies. And some of the ways we do that is with these tax-free loans. And these tax-free loans that we talk about are things like a single purpose loan, which can be done for 1 year in isolation. So this is sometimes referred to as a shareholder's loan or a net debit balance in the director's advance. So if you take money out of your corporation, basically CRA's rules tell us that you're allowed for that money to be sitting there as a loan that you owe back to the corporation for 1 year, but it needs to be repaid by the subsequent year. And in that subsequent year, you wouldn't be able to do a loan again. But once that loan was repaid, you would be able to do it in the following year. So we usually refer to that as a debit balance in the director's advance, or it can also be referred to as a single purpose loan, which is effectively a shareholder's loan for 1 year and 1 year only. Now, there are other longer term loans that can be done to employees of the organization, not to shareholders. So you have to have a T4 from the corporation to use these. But there's loans for homes, the purchase of a home. Now, it must be your residence, so it can't be an investment property, but it could be, it doesn't need to be your principal residence. It could be a cottage or a secondary residence, as well as for the purchase of a car. And again, if you're contemplating looking at either of those as strategies to optimize your tax planning, I strongly encourage you to reach out and connect with your account manager who can help you to figure out how to take advantage of those in a way that's going to make sure that you stay compliant with CRA. Because there are risks if you set up those loans incorrectly. They could be deemed to be shareholder loans and then due to be repaid within that 1 year that we talked about earlier. Now, I do want to have a brief discussion about salaries versus dividends, because this is a question that comes up quite frequently and is somewhat important when it comes to deciding how to optimize your tax planning. So one of the big questions when it comes to your tax planning is how you're going to remunerate yourself. So the money that you are taking out of your corporation, are you going to consider that a loan, a salary, or a dividend? So loans usually have very specific rules around them that determine whether we can call them a loan or not. Now, as far as whether we want to declare the money you're taking out as a dividend or a salary, this is really up to you and your accountant as a decision that you can make. And there are pros and cons of both. And as I mentioned earlier, this is an art, not a science. So there's no right or there's no wrong to doing this. So bear with me 1 second. I do see a question that's coming in our Q&A panel. Is there any reason to seek additional tax planning advice beyond my Wallen Associates account manager, or should that be sufficient? I have a unique situation this year, retirement. So I would say there are situations where we do need to bring in outside professionals. Usually the only other person we're going to bring in is a tax lawyer. And these are usually reserved for complex situations where we're going to do corporate reorgs and corporate restructures and planning for estates. If you have a lot of retained earnings inside your corporation and the plan is to leave that to the estate, we'll probably want to bring in a tax lawyer to figure out some optimized tax planning as far as long-term estate planning. Outside of long-term estate planning, if the corporation has limited to no retained earnings in it, and those are planning to be withdrawn before you ultimately pass it on to the estate, then the tax planning you're doing with your accountant should be sufficient. In addition, if your accountant does need to bring in a professional, we'll let you know and we'll say, hey, we think we've got a complex situation here where we've got some opportunities. We'd like to bring in an additional resource. Does that make sense to you? Are you interested in us doing that? And we do have professionals that we can bring in to that. So excellent. We got one more question here. If we take dividends for the lower taxation and put this after-tax money into a tax-free vehicle, is that better than salary? And do the same. So this is a common question. Let me bounce back here for a second to the marginal tax rate. So you saw here that there's different tax rates for dividends than there are for other income and there is for capital gains. This often creates a misconception that you pay less tax on dividends than you do on a salary. And the reason I say that as a misconception, even though I just showed you a tax schedule that shows a lower tax rate on dividends, is because dividends are paid out of retained earnings. So money that has been taxed already at the corporate tax rate, and they're also grossed up. So what happens with dividends is there's a dividend gross up amount, and then there's a dividend tax credit, which effectively means you'll pay less personal taxes than a comparable salary, but that's because those dividends are coming out of money where a corporation has already paid tax on that. And there's something called the theory of integration, which is intended to make it such that there is no financial advantage of choosing dividends over salary. So when we look at the total tax that you'll pay on a dividend, which is adding up the personal tax plus the taxes that have been paid on the corporation, there is no significant difference between the taxes on a salary. Now I say taxes specifically because CPP and EI are not taxes. Those are, CPP is a pension plan and EI is an insurance, a form of insurance, employment insurance. Outside of those things, the actual taxes are basically the same. Now, there are different reasons that you would choose to use one over the other. Now, typically during your income earning years, our firm generally recommends paying yourself out in the form of a salary. And this is for a number of reasons. Probably first and foremost is it is eligible for RRSP room. So it builds up some RRSP room, whereas a dividend is not. It's also eligible for CPP. So CPP is a funny thing because obviously it creates an obligation to pay additional money right now, today, that you wouldn't have to pay with a dividend. However, from our perspective, that is a positive. It may not be the best investment rate of return out there, but it is a guaranteed rate of return. And with no other form of pension, it's great to have at least a guaranteed income in retirement, even at a modest level that the CPP provides. So if you're contributing into CPP, you're going to get back out of CPP a pension that is directly correlated to the amount that you have paid into it over the years. So if you go with the form of a remuneration in the form of dividends, you will not be building up any CPP contribution and you will not receive any CPP benefits in retirement, or at least less CPP benefits in retirement. Now, a salary is also going to be an expense deduction. So it's going to reduce the amount of taxes that a corporation pays. And because it's deductible, the employee is effectively paying the full personal tax rate. Now, a dividend, what happens with a dividend is you have inside your corporation, you have your revenue minus your expenses, because there's no salary, which is an expense. You would have more income and pay corporate tax on that income. That then moves over to your balance sheet into what we call retained earnings. And this is the money that the corporation has paid corporate tax on. And the retained earnings has an opening balance and a closing balance. So you might start with a retained earning balance at the beginning of the year, add to it or subtract from it, depending upon whether you had a good year where you made money or a bad year where you've lost money. And then a closing balance. And you can subtract from those retained earnings by issuing dividends out to shareholders of the organization. And those dividends, because they're coming out of funds that the corporation has paid tax on, are eligible for a dividend tax credit personally. So, the way they do this with a dividend gross up and a dividend tax credit is basically what keeps accountants employed. But the easiest way to understand it is they're just giving you credit on the personal side for the taxes that have already been paid over here on the corporate side. And people have done all sorts of fancy calculations across all the provinces, across multiple time periods, have found that there is no significant difference. We're talking a few pennies, few dollars difference between any of the tax brackets and any of the provinces, in any of the strategies. So there really is no significant advantage there. Now, we do have some other advantages around cash flow and greater flexibility that does come with dividends. So from a cash flow perspective, you've got some advantages. And I do see a couple of questions that will come up here. I'll come to those in just 1 second once I finish here. So first of all, when I talk about cash flow, we've already pointed out one benefit of the dividend, which is you're not paying into CPP. You're not getting it later, but you're not paying into it. So you have less cash going out to pay in CPP today. In addition, the way dividends work is the company does not do any withholdings on the dividends. The shareholder just pays the taxes that they owe on those dividends when they file their tax return in April. With a salary, there is a required withholding. These are referred to as source deductions. We went through a whole bunch of planning back in November and December for those people who wanted to maximize that. So basically, when you pay a salary to an employee, the employer is required to withhold at minimum the CPP and usually the personal taxes as well, and remit that to the government on behalf of the employee. And they're supposed to be paid either by the 3rd, 10th, or 15th day of the month following which the employee was paid. So i.e., anyone who wanted to have a salary in December of this year needed to pay by either January 3rd, 10th, or 15th, depending upon their threshold. I'm not going to get into those thresholds. We have a whole nother seminar which has been recorded. You can go back and watch that. But that would, in theory, be due earlier than a dividend that was paid in December, because you wouldn't have to pay the taxes on that until you file your tax return in April. So it's giving you a little bit more flexibility on that. In addition, you've got a little bit more timing and flexibility on when you're going to declare that. So let me go and look at these questions now that we've got. So first one here is CPP. Do we pay both parts? And if so, what is this percentage? So I don't remember the percentages off the top of my head. I think it's because we've got a calculator that does all, I think it's 5% or something like that. And both, yes, there is both the employee and the employer portion that does need to be paid when we're doing salary. And so I hope that answers that question. And we do have a tax planning worksheet where we do calculate that. In addition, you can also go onto the CRA's payroll calculator, figure out that. Thank you, 5.25%, Rachel. Much appreciated. That was close. And will I be sending a recording of the slides? Sending us the recording and the slides. So the recording will be available and is available right now on our Facebook page. As well will be uploaded into our YouTube channel. And we will probably make the slide deck available as well to any of our clients. So we got one more that's come through here. If retaining earnings inside the corporation and subsequently investing, doesn't this act as an RRSP tax deferral vehicle? What is the advantage of pulling out as RRSP in this case? This is a great question. So I am going to come to this, and so bear with me, my anonymous attendee. We're going to be talking about the difference between RRSPs, investing in the corp, and you're very close to the target here, which is a corporation does provide a deferral strategy, but there are other advantages and disadvantages, and we will talk about that as we get into that. So hopefully I've covered everything when it comes to salary versus dividend. If you have any more questions about salary versus dividend, let me know. I'm going to move on briefly to income splitting, and I'll try to move through this section quickly so we can get into the question that our attendee has asked when it comes about the different forms of remuneration. So income splitting, big thing to know here is beware of the new Tfsa rules. This is tax on split income. Now, Tfsa rules are really around dividend income splitting. Salary income splitting has not changed significantly. It is subject to a reasonableness test. It has always been subject to a reasonableness test. This is nothing new. We've still been able to successfully do very strategic income splitting strategies with clients for years, paying salaries out to spouses and children. With spouses and children, we do still need to put some documentation around that and do everything we can to make sure that this income splitting can stand up, but it's still a legitimate strategy. Now, just to digress before we go into the splitting income through the form of salary, splitting income through the use of dividends can still be done. It's just that Tfsa, tax on split income, makes it less effective for a large group of clients where it used to be effective. Once upon a time, we used to even be able to do income splitting with even children under 18. Then they put in something called the kiddie tax rule, which was basically the incubator for Tfsa, which basically made it tax inadvantageous to do any income splitting with any children under 18. And that eliminated a lot of what we were doing with trusts and income splitting to children under 18 through the use of a trust. There are other advantages of trust, but again, another session for another day. But we were still able to do income splitting through dividends with spouses and children over the age of 18. Along come the Tfsa rules in late 18, early 19 that basically eliminate splitting income with anyone who's not actively involved in the business, which they defined as 20 hours a week, and really changing that age limit on which was before under 18 to now 24, which basically said virtually impossible to do with anyone under 24, which don't get me on my soapbox about that. And then over 24, again, active involvement in the business, heavy requirements. There are some loopholes still there. One of them being once you reach age of 65, you can do income splitting through the use of dividends with your spouse. So we still do income splitting through the use of dividends, just not to the extent that we once did. And there are still some advantages of doing that. Again, if you're unsure, thinking about dividends versus salary, great conversation to be had with your account manager. Now, I do want to just show you an example of the actual tax savings that would be achieved by doing income splitting. And I'm not saying that this is what should be done. This is just what could be done. So if you had a situation where you had a total salary, and by this I mean T4 salary being distributed to one person in the corporation, you'd have a total obligation of about $29,505, including both the employee and the employer portion of the CPP. Now, if you split that amongst two people equally, you can see that the income tax portion is substantially less. And the total obligation, even with the CPP, which is a benefit that you're going to receive in retirement, right? So if you're paying more into CPP, you're going to get more back out down at the back end of this. And not even factoring in the CPP benefit, you've got over $4,000 benefit by doing income splitting in this fairly common scenario of about $100,000 of total remuneration. So income splitting is really effective. And this is because as we talk about these peaks and valleys, the more of those lower tax brackets that we can use up, the lower the total tax is going to be. Now, when it comes to income splitting, as I said, income splitting through the use of salary is subject to a reasonableness test. But the reality is, I don't know anyone, man or woman, who makes financial decisions about their owner-managed business without the involvement of their most trusted advisor, which I wish was their accountant, but truthfully is their husband or wife. And just for being their coach, their confidant, their financial advisor, justifying salaries in the neighborhood of $20,000 to $30,000 has been successfully defended in many, many situations. Doing income splitting with family members and children who are helping with social media, website, bookkeeping, filing documents, organizing documents, receipt capture, all sorts of different things that the kids could be involved in. Very easy to justify salaries in the $10,000 to $15,000 to at least make use of getting that basic personal exemption, which sits around the $11,000 mark. And that means we can basically get money out to these people virtually tax-free, or at the very least at lower tax brackets than what you would be taxed at if you took all the money into your own name. So income splitting is still a very effective tax planning strategy, but shouldn't be done without the advice of your accountant to make sure that you have done things properly and you have the documentation in place that if CRA comes knocking, you can stand up and defend that strategy. So now getting into the weeds, where to save. I'm going to start with a couple of low-hanging fruits. So first of all, RESPs. Anyone with children, the very first place that you should be saving money is into your RRSP at a rate of about $2,500 per year. So the RESP, it doesn't reduce your taxable income the way an RRSP does. And the RRSP gains do become income, but they become income to the beneficiary, which is typically the children, and it's usually during years in which they are in school and have education deductions and stuff like that. But the real reason that we do recommend this is because of the Canadian Education Savings Grant, which basically means the government is going to give you money for money that you put in to your RESP. And when it does come out of the RRSP, because it's going to become income to your children, it's going to be taxed very effectively. So there are different thresholds for CESG. There's some additional bonuses that are based on your income level. Outside of those, so there's basically an additional $100, maximum $100 per year if you're under a certain threshold, or $50 if you're, there's basically two thresholds. You can get either an additional $50 or an additional $100 per year. But for the average person, the maximum is going to be $500 per year based on a contribution room of $2,500, up to a maximum of $7,200 is the maximum total CESG grant that you can get. But that is something that you should be contributing to. If your children, if you have not been contributing to that and your children are, a little bit older, you can contribute based on past opportunities. However, there are some limitations. Usually you can only make a contribution that will cover the last 2 years and get the CESG for 2 years. So the maximum amount of grant you're going to get in any 1 year would be $1,000 based on a $5,000 contribution. And that's assuming that you had room carried forward from prior years. So that is the first and foremost place, because I think, saving for your children's education is a necessity in my opinion. And that is the very first place that everybody should be saving, because you're going to be getting some government grants by doing so. The next place is if you are eligible for a disability tax credit, then an RDSP is another great tool. And again, it's because they have the grant that's available. So it's the Canada Disabilities Savings Grant. We've got some links in here for those people when we do share out the slide. I'm not going to belabor this too much, because the key here is you need to be qualified and you must be approved for this. There's some documentation that's required by doctors in order to qualify for it. But there can be some big benefits to it. So I'm just going to say, hey, if you've got the ability and you do qualify for the disability tax credit, this is probably the second place you should be contributing, because again, you're going to be eligible for some grants. Again, there's going to be small amounts here because there's going to be maximum amounts for that grant. And some maximum benefit, maximum contributions that are going to make sense for that. So next we've got RRSPs, and this is the one I think probably people have a layman's understanding of. Most people are familiar that they do reduce the taxable income. So for every dollar that you contribute into your RRSP, assuming you've got room for the contribution, that's going to reduce the amount of taxable income that you have on your T1 or your personal tax return in that year. And most people are also familiar that the RRSP room is based on your salary. So again, if you're receiving dividends, you're not going to be building up any RRSP room. If that is a strategy that you want to make use of, you've got to be aware of that. In addition, because typically the strategy when you are an owner manager of a business, the goal is to leave money inside your corporation and keep your personal tax as low as possible. your personal salary as low as possible so that you're at the lowest marginal tax rates because of that gap between 12.5 and 53%. So as a result, you're not going to build up as much RRSP room as, say, a full-time employee might be building up. So RRSPs are still a good tool and a useful strategy. They're not going to necessarily play as big a role as someone who is obviously a full-time employee, which is why we're going to be looking at a holistic plan that takes into account RRSPs, TFSAs, savings inside the corporation, potentially unregistered plans, potentially individual pensions plans, lots of different things that might come into play. So right now for 2020, the maximum amount that you can get for any 1 year or for the 2020 year is going to be $27,230 or 18% of your salary, whichever is lower. So it's going to be either 18% up to a maximum of $27,230. Now, RRSPs are great because they are a deferral. They are a guaranteed deferral. So you're reducing the amount of taxes that you pay today. And when you take them out of your RRSP in retirement, they become taxable, and you are forced to start withdrawing them when you hit 71 in what's called a RIF, where they make you take out about 5% of the balance every year. If you don't take it all out before you die, they will become taxable to the estate. So they do become taxable. It's deferring taxes from today until a future year, a future unknown year. What you can also do with an RRSP is achieve a tax savings as well as a tax deferral. That tax savings is achieved by contributing to an RRSP at a higher marginal tax rate than where you withdraw, than the personal tax rate at which you withdraw an RRSP. So in theory, if you're contributing at years where you're in a mid to high tax bracket and then withdrawing out of your RRSPs in retirement when you're at a lower tax bracket, you're actually moving income that would have been taxed up here, let's say potentially 53.53%, and withdrawing it down here at a tax rate, which is potentially 20%. Now that all is, like I said, dependent on a bunch of unknown factors. Where are you going to be? What's your income level going to be when you reach retirement? What's your lifestyle requirements going to be? You could potentially increase your tax obligation by contributing down here at 20% and withdrawing up here at 53.53%. And that's why we say never contribute to your RSPs when you're below that $44,000 threshold and below that lowest tax bracket, because at best, you're going to get just a tax deferral. You might get a tax deferral, but an actual increase in total tax obligations. The other thing to be aware of when it comes to RSPs, which, I'm not trying to discourage people from using RSPs. I just want to make sure that you're aware of all the facts. When it comes to an RRSP, you might have multiple different types of investment inside an RRSP, because an RRSP can invest in lots of different things, in stocks and mutual funds and a variety of different things. And it might receive dividends, it might receive interest income, it might receive a capital gain. But inside an RRSP, none of that matters. And you don't pay tax on any of that until, as we said, you withdraw the money out of your RRSP. Now, that is potentially a pro or a con, depending upon the type of investments. So looking at what types of investments you have in different places is something really important to think about. Now, if we talk about a capital gain, again, one of the things you noticed in the capital gain spread, or in that original tax planning worksheet, which showed you the different tax brackets, it showed you basically capital gains are half of that of regular income. And that's because you only pay tax on half of your capital gain. Now that's inside either an unregistered investment or inside of a corporate investment. Inside of an RRSP and inside of a TFSA, that is not applicable, because an RRSP, you're not taxed based on capital gains, you're taxed based on withdrawals, which effectively means on a capital gain, you're going to be taxed on 100% of your gain. Whereas in a TFSA, you won't be taxed on any of it. Inside of a corporation, you will be taxed at only half of it. And inside of an unregistered personal savings plan, a personal investment, you would again be taxed on half of it. So which is a bit of a disadvantage when it comes to the RRSPs. So looking at what types of investments that you have in an RRSP is an important strategy. And that is something you should be discussing with your financial advisor, who can give you more guidance on how to structure your investments as efficiently as possible. But be aware of that subtle difference with an RRSP. Now, a tax-free savings account is kind of the polar opposite of an RRSP. So an RRSP reduces your taxable income, and when you take money out of your RRSP, it becomes taxable. A TFSA does not reduce your taxable income, and when you take money out of your tax-free account, you don't pay any tax on it, because money that you put into your tax-free savings account has already been taxed. In addition, the beauty of the tax-free savings account is any growth that you receive inside your tax-free savings account is tax-free, as implied by its name. So if you have a capital gain, if you have a dividend, if you have interest income, you will pay zero tax on all of that, which is, first of all, that is better than even the capital gain, where you would pay tax on half of it. So this is the most underutilized tool. It's also a great tool for keeping an emergency reserve. So if you ever need money and you need to draw from it, one of the great places to draw from it is a tax-free savings account, because you can take money out of your tax-free savings account. You have to wait a year, but after waiting 1 year, any money that you took out of the tax-free savings account, that room will come back to you, and you can then contribute back to that, anything that you took out, plus any additional TFSA limit that you were given. And the limits have changed a little bit over the different years. 2015 was the one anomaly, but it's been around that $5,000 to $6,000 range each year. And right now there's a total TFSA contribution room, if you have never contributed and you are more than 18 years old in 2019, of $75,500. And this is an very often underutilized tool that people aren't contributing to. And what I often see in many, many situations is people have tons and tons of equity in real estate and very little use out of their TFSA. Now, if you've got $75,500 of TFSA room, taking that money out of your corporation and contributing into your TFSA would not necessarily be a great strategy, because that's going to be $75,000 that you've got to take into income in order to contribute it. And because of these marginal tax systems, that would be a peak. And we're trying to avoid these peaks and valleys, right? But one of the strategies that you could look at doing is using home equity line of credit or traditional mortgage, and when you do a refinance, and making sure that you get enough to be able to max out and contribute to your TFSA, because that's not going to be taxable income to you. And again, your house is going to continue to increase in value of a function of its purchase price, not as a function of its debt. And debt right now on real estate is, at an all-time low. So being able to borrow money at, long-term fixed rates at, low single digits is a very tax effective strategy. You can literally go get a line of credit from a bank, go and put it into your TFSA, invested in the same bank that lent you the money, and they will give you a dividend that is higher than the interest rate that they are charging you to lend you the money, by investing in their own stock, plus have the market upside of the potential increase in the share value of the price of the stock. Now, I'm not a financial advisor, and I'm not recommending you do that. I'm just saying this is just one example of some of the things that people have done in the past, where you can use other people's money to make money for yourself, and to use leverage. And leverage is one of the most important ways that wealthy people become and remain wealthy, is by using other people's money to make money, and by compounding that growth as much as possible. So TFSA, a very effective and very underutilized strategy for you. And now we also have corporations, and savings within a corporation is a very, very effective tax strategy. And this should be done where and when applicable. The advantage of saving and investing inside the corporation is, as the other person mentioned, it's the ability to defer, much like an RRSP, in that you're going to pay less tax today. And if you eventually take the money out of your corporation, assuming that you're saving towards a retirement plan, you will pay when you take the money out of your corporation. Now, if you're taking it out through the use of dividends later, you might just pay now and not have any to pay later. Because actually, if you look at what the effective tax on a dividend of around $30,000, it's basically zero, because the total taxes that you would pay on an equivalent salary are less than 12%, which is what the corporation has already paid. So what's quite common is people will save money inside your corporation, pay 12.5% today, draw that money out in retirement through the use of dividend, and pay no additional tax. Now, it's not tax-free. It's that they paid the tax when they earned the income, so they're able to draw that money out tax-free in retirement. And that creates the tax deferral. So that is very similar to an RSP. And some people would say, well, one, why would I do that when I have to pay 12% here, whereas an RSP I would pay 0%? And there are a couple of reasons for that. First of all, an RSP, you're going to be limited in the amount of contribution room that you have. The only limit to how much you can leave within the corporation is a function of how much you've actually earned. So that's probably the first and number one reason that you're going to do that, because we do encourage people to make use of and contribute to the RRSPs to the extent that they have room and it makes sense based on their marginal tax rates. But you're going to quickly max that out. And so the corporation becomes another vehicle in which to save in. In addition, the other advantage that you're getting inside the corporation, or the other difference, maybe it's not fair to call it an advantage, is that when we talk about capital gains, any interest income or capital gains or dividends that you receive in the corporation will be taxable to the corporation in the relevant or corresponding period. So the income it earns is taxed then, whereas an RSP, that income is deferred. But for example, on capital gains, it's going to be more favorably treated inside of corporation than it would be inside of an RSP. And with dividends are a whole nother beast. Within a corporation, when you receive dividends, you're going to pay the tax on those dividends today, but they go into a special holding account called an RDTOH, stands for Recoverable Dividend Tax on Hand. And you will get 100% of that tax back if and when you issue a dividend from your corporation. So it's from a cash flow perspective, you pay it now, but you get it back in retirement when you start to pull money out in the form of dividends, which again can be potentially a positive thing. So it's good to pay in while you've got money coming in and get money back when you're in retirement and you don't have a lot of money coming in. So these are the differences, not necessarily pros and cons of the different things. However, again, the Liberals have added some new tweaks to saving inside of your corporation, which has created or taken away some of the advantages that used to exist. And what they basically said is, on new passive income, if you have more than $50,000 of net passive income, that each dollar over $50,000 will reduce your small business deduction limit. So your small business deduction limit, as we mentioned earlier, is up to $500,000. So on the first $500,000, you will pay a lower tax rate. But every dollar over $50,000 in passive income is multiplied by 5, and then that reduces your tax or your small business deduction limit. So if you had $150,000 of net passive income, so your total passive income minus your costs or your expenses on that passive income, if that's $150,000, that would be $100,000 over the threshold, which multiplied by 5 would be $500,000. So your small business deduction limit of $500,000 would be reduced by $500,000, and you would pay the tax rate at the full rate. which you can see federally goes from 9% to 15%, and provincially goes from 3.2 to 11.5%. So you're basically going from 12.2% to 26.5%. So you're more than doubling the tax rate on that. So these are things that you need to be aware of. Now, there are some strategies to mitigate this. Again, if you're approaching that $50,000 threshold, great time to have a conversation with your account manager around different insurance strategies that can be used that you can invest in that won't count towards your passive income thresholds, as well as strategies around holding companies that can be used to minimize and offset the net passive income. So we've got different strategies there that we can use to basically use different salaries and different tax strategies to reduce what the total passive income is. But that can only be done when we're using holding companies, which can be a very effective tax strategy. So basically, a corporation is a very, very effective tax strategy. It should be used, but probably the first place you're going to save is first into your RESPs, then into any RDSP if you have any room, then into RRSPs, then into TFSAs, if done effectively, right? We don't want to save into a TFSA at the expense of a marginal tax bump. So that's something you really, if it's $6,000 and you're doing it regularly, probably an effective plan to do. But to make a big lump sum $75,000 contribution, not necessarily a good strategy without discussing it with your account manager first, and then into your corporation, and then probably lastly into an unregistered investment account. So this will not reduce your taxable income. It is subject to the personal income tax rates on all of it. Really, the times when you'll start to use an unregistered plan is if you've done something like a Smith maneuver. So a Smith maneuver is a way that you can borrow money against your property, your residence, and invest that into the market and make the cost of borrowing deductible against those investments. This is called a Smith maneuver, and it can be done, but it would be a personal unregistered investment. So you're going to have the income be taxable at your personal tax rates, your marginal personal tax rates, and they will be subject to capital gains, as well as whatever the rates are on your marginal rates for any interest income or dividends. But you'll be able to deduct whatever costs that you have against that personal income that you have in these unregistered investments. So these can come into play. Typically, they only come into play for the most high net worth individuals and are probably the last place in which that you are going to contribute. So I've said a mouthful here. We've got about 3 minutes left in the session. But I can stick around a few minutes longer if there are any other questions. I know we went through a lot, and this is one of those things, as much information as we can give you, it still makes sense to have a conversation with your account manager. And this is something that you guys will be doing on an annual basis. If you're new to us, if you're not a client of ours, annual tax planning is a big part of what your account manager will be doing with you to figure out, okay, how much money are we going to take out of your corporation? How much money are you going to contribute to your RRSPs? Have you considered contributing to your TFSAs? What kind of room do you have in your TFSAs? And for those of you who are clients, we do a personal net worth assessment. We're looking at your whole plan. How much do you have saved in all these different places? How much equity do you have in your real estate? And what's a holistic plan to making your money work for you? So excellent. So it looks like no more questions coming in from Facebook. I don't see any other questions coming in our Zoom meeting here. So with that, I'm going to thank everyone for taking time out of their busy day today to join me, and let you know we do have another webinar this Thursday. It's going to be on the new PD27 form and some of the changes to preparing your T4s for you this year with the 4 new boxes that are going to be added. This is, we're only putting this on once. It will be saved and replayed. It's going to be an interesting session for anyone who has taken advantage of the wage subsidy. If you're not using the wage subsidy, it's probably not really applicable. Oh, we do have one more Facebook question that has come in. What is passive income? Yeah, I should be careful about throwing out terms without explaining them. So active income is income that you earn from operating business. Passive income is income that you earned from investments. So it could be stocks, it could be real estate investments. It's just not part of your active business, or for most of our clients, your consulting business, or your retail business, or whatever your main business is. That's considered active business income. And then investments are considered passive income. I hope that answered your question. If not, post another one. And otherwise, everyone else, thank you for joining us live. We'll see you, if not next week. We do these every month. Our plan is to have a minimum of 2 webinars every single month. We'd love to hear from you guys, what kind of content you're finding useful, what type of content you're finding valuable, how we can make these sessions even better for you. We're committed to providing you guys the content that you need in a way that is useful and understandable. And if we're not doing that, we need to hear from you what's working and what's not working. So please do share that with us. GIC income. So that would be considered passive income. I'm assuming that that's what the question is. Yes, GIC income is investment income. It would be passive income. I'm not sure if you're asking whether a GIC income should be held, where it should be held. So first of all, let me say I'm not a big fan of GICs. Their investment rate of return is, if you factor in inflation, the rate of return is negative. But those would be considered passive income, and that's what we call the income that you're getting on the GIC is interest income, and it would be called also passive income if it's held inside of a corporation. So great. Again, thank you, everyone. I can see some of you are starting to weed out, so I'm going to close it off there. Rachel, am I good to go? Good to go. Okay, thank you very much, everyone. Bye for now. Oh, yeah. Actually, I think I see something in the chat. I'm just going to double check that. Before I log off. Oh, just saying thank you very much. Well, Nicole, I think now is definitely an interesting time. Yeah, if you're thinking about getting incorporated, book a consultation with Karen or Rachel. They can walk you through whether for your situation it actually makes sense. But I'm glad you enjoyed the session today, and thank you for your time. Bye for now.